Oh, oh, oh.
All right, hi everyone. Sound check. Can you hear me? Hi, hi, hi. Yeah, I see in chat. A lot of greetings. Okay, so first of all, I'm sorry for yesterday's lecture has been postponed. My fault. And welcome to the course. Today is the first lecture. First of all, let me introduce myself. My name is Marat Kurbangalev. Uh, I'm okay if you call me just Marat. It's fine. And I'm a senior lecturer at the School of Finance in Moscow campus, High School of Economics. And I was asked to lecture you this course. Actually, I designed this course a couple years ago, but unfortunately, last year I was forced to take a pause, and another lecturer taught this course last year. But now I'm getting my course, my baby back, and here I am. And today's lecture is going to be introductory one. Um, First of all, I'm going to tell you about how we're going to live this module together, how the course is structured and how it's designed. So what's the most key topics it covers, and the most crucial for you, how we're going to assess your progress and how you're going to get your grades. So thumb up if you think I'm right. And that's the most important thing. Okay, so, okay, let's move on. Here is a roadmap of today's lecture. I'm going to start with a short overview of the course and briefly describe you, I'm going to represent you an assessment schema. After that, I will give you the voice, and if you're going to have some questions, you will be free to answer me, and I'll bring you to air. All right. After that, we go into get to the point and discuss and get into the basic concept of the course of the risk and risk modeling. So the basic idea today is to digest the title of the course. So it has three words, um, risk assessment model. So we're going to be pretty clear by the end of the lecture what each of these words mean separately and together and what we're going to do in this course. Um, so here's the content of the course. Um, It has 5 topics. 3 of them are pretty general and short. I think that we will be able to cover this first 3 points very fast. I think it's going to take like 3 lectures, so we're not going to waste too much time on that. And then we're gonna go to the last 2 of them, which are more fun from my point of view, because last 2 points represent application of the algorithm and a concept that we're going to learn um, during first 3 lectures. And we're going to look in details how these modeling process and algorithms and concepts are applied to the modeling and assessing and managing financial risks like market risk and credit risk. I intentionally divide these two kinds of risk, and actually this is a classic approach because they are very different in terms of their nature and how they actually arise and perform in the real life. So the market risk, more like continuous type of risk, which represents processes that vary smooth, and despite the randomness, we can represent them as a pretty smooth concept. As opposite credit risk happens as a jump process. So we have slightly different approaches to model them and to quantify them, regardless the general framework. Okay. All right. So how are we gonna do this? So we're going to have several lectures and several seminars. And talking about lectures, today's lectures probably going to be exception of the general rule, because from the very next lecture that we're going to have tomorrow, we're going to use not just slides, but Google Colab notebooks. So the lectures are going to be like workshops, because I'm going to use notebooks containing some theory, some formulas, some concepts, and I'm going to mix them with the code and actual application of those concepts to the real data. So it's going to be like theoretical and practical classes as well, so kind of mixture. And I'm going to spread those templates, those Google Colab notebooks, among you before classes and after them, because I'm going to write some code. You can follow me during the class, during the lecture. So you're going to have all those templates with the code and with the theory, and you can use them in the process of preparation and completeness of your homework. I'm going to address the homeworks a little bit later, all right? As for the seminars, they are going to be in a small groups, so like 20 students. And the main point of the seminars is to discuss and digest the homework that you're going to prepare. So before the seminar, I need the chance to go through all of your work and assess it, just to let us chance to understand and correct all the mistakes and errors that you might make at home. And we're also going to deepen our understanding of the subject and the concept, so we're going to get into more details during the seminars and solve slightly another problems. And after that, after all this practice, we're going to have another test. So we're going to spend last 20 minutes of each seminar for the test. All right, and that's what comprise the assessment schema. So first of all, the final grade is going to consist of 3 home assignments that I have already mentioned. It's just a regular multiple choice test. You're going to have like a week for its preparation and completeness. It's going to contain either theoretical or numerical questions. So some of them going to concern definitions or checking some properties or something like that. Other questions are going to be numerical, so you're going to do something with the data and come up with some number or some range of numbers, something like that. All right, and you have to complete this test just before the seminar. So all the deadlines for this tests are beginning of the seminars. All right, and each of these tests is going to contribute 10% of the final grade. So 3 tests together makes 30% of the final grade. All right. Another 3 tests we're going to hold in class, as I've already mentioned. We're going to spend last 20 minutes of each seminar for the test. It's just like a homework test, but now you have limited time to complete it. But at the same time, if you've done your homework and you spent the time at the seminar very fruitful, so you are able to complete this test just in 20 minutes and get another 15% of the final grade for each test. All right. So during the seminars, you can combine. You can gain 75% of the final grade. All right. So if everything is flawless and you absolutely succeeded at all these tests, you're going to obtain 75%, which give you final grade 8. All right, because we going to apply arithmetic rounding, grading your work. All right. So, for example, if you're brilliant at all of those tests, you have already excellent mark. All right. The last 25% you can obtain through the exam. And here we have 2 options. Students may choose the format of the exam. So they might choose the regular test, just like tests you going to complete at home or at the class. The only difference is just covers the entire material of the course, right? And it's going to last like 90 minutes, all right? So it covers everything. And this is one option. Another option, students may form little groups up to 3 students, up to 3 teammates, and try to work on small numerical project. So those who is going to choose this option, they are going to be offered technical requirements and a data on one of those kinds of risks that we're going to cover, either market risk or credit risk. And they will be asked to apply the entire algorithm that we cover in this course to the assessment of this kind of risk. So I'm going to provide you with a data sample and some technical directions. And you go in to apply every concept that we cover in this course to the data, and make a little notebook, like a Colab notebook, and record a little presentation that describes the logic and every step that you applied in this project. And this is another way you can gain 25%. So this option for brave and eager minds. Okay. Is everything clear still? Do you have any questions? If you have a question, please raise your hand. You can do it by hitting the button at the right lower corner of your screen. So let me check everything is clear. If you don't have this option or you feel more comfortable to write your question, feel free. Write it in a chat or in a questions section. It's okay, it's fine. All right. I think I have no questions. So if you go into okay, we have a question. Will you provide additional info for the project? I will provide. Um, I will give you a data sample, description of the data, and I'm going to give you the essence of the steps and the algorithm that you have to apply. You need to let me say complete all the steps with the concepts and the methods that we cover in our course. So, for example, let me give you an example. You're provided with a data sample, and I say, okay, please use this sample to construct the portfolio, and please assess value at risk measure. And for example, say, please apply delta normal approximation. All right, and you go into use all the materials and all the notebooks and all the practice that we've done to fulfill this task. All right. We have on the first week only lectures. On the next week, we will have only seminars. That's correct, Maria. You're absolutely right. Can we see projects of the last year? I think it's possible. Let me provide you with examples in a week, all right? That's for Vladislav. Should we bring computers to every seminar? Absolutely, at least, because all of our classes are online. I have no idea how you can participate without a computer. Well, maybe with a smartphone. Let me tell you this. You can watch lectures with any device you would like. It's not necessary to have computational abilities and capacity during the lecture. It's okay, because I'm going to show everything, and I'm going to share with you all the materials like in notebooks, etc. But if you would like to follow me and my colleague Zina at seminars, I would recommend you to have your laptop or a stationary computer. All right? Because it's obviously that you can complete all those tests, no matter whether they are home tests or in-class tests with smartphone. It's okay. But I have no idea how you go into make all those calculations, all right? How will we have in-class tests if we are online? It's a good question. I'm going to post tests in LMS. So it's just the way I'm going to provide you with the home tests. So if you're online, at some point of the class, I'm going to say, okay, in 2 minutes, I'm going to post the test form, and you have roughly 20 minutes to complete it. All right? So after 20 minutes, I'm going to make sure that everyone submitted the forms. All right? And if something wrong, probably I will prolong or extend time for completion. All right? Should we bring computers to the seminar? So, okay. I think I provide answers to all questions. Okay. Should I move on? Great. Okay. Now let's get right to the business. Okay, let's start with the concept of the risk. And we start with the question, what is the risk? Because I think um, many of you have intuition about what it is. So, like, regular view on this definition is the effect of uncertainty on our objectives. So, for example, we go in to vacation, and our purpose and our goal is to have fun, to get some pleasure or something like that. And it's clear that no matter how good we're planning our vacation, something wrong may happen, something that we not control, and something that we cannot anticipate. And all those factors can ruin our vacation. And that means that something that out of our reach and something out of our control can actually affect the objectives of our projects in our plans. The same applies to any economic activity, no matter what it is. Is it your individual project? Is it the project of some entity or company? Is it some government policy or something like that? There are always something that uh, may affect the performance of the project, not the way we would like it to be. All right, but that's quite ordinary and unconceptual, because so we don't actually understand what to do with this view. So let's switch to the conceptual view of the risk. And this view actually separates uncertainty and risk, because actually we think of uncertainty that's something that we not only cannot control, but something that we actually cannot measure. When we talk about risk, we actually think of randomness of known nature. It means that actually we can measure risk. We can apply some mathematical concept. We can actually use data to infer the entire perception of the nature of the risk and the randomness. And that's what makes risk different from the uncertainty. And once we come up with this view, actually now we can get formal and go to the mathematical view. So we can actually formalize the risk. And speaking rigorously, we represent risk as a probability space. I think you may heard this this definition from probability theory, but more practical view of the object that we're going to deal with is just probability distribution. And we go into look at the distribution in two ways that you used to apply in your classes. Those are cumulative distribution function and probability density function. Okay. So now let's have our eyes on the slide, because that's exactly the object that represents the risk. This is the distribution, and this particular case represents density probability function. Actually, it represents two kinds of risk. One of them drawn with a green color, another one with a blue color. This is just a schematic representation just to make this picture nice to the eyes. So you can probably recognize something that might remind you normal distribution. So you recognize those bells. But in a general case, we're going to deal with distributions very different from what you can see on the slides. the distribution may have skew, they may be heavy-tailed, they may have multiple modes. So here you can see the single hump, but in reality, they may have several of them. Also, you can see continuous distribution, but in many cases, we're going to work with discrete distributions. So that's what we'd like to model. I also would like to stress the fact that on a horizontal axis, we have something that represents the indicator of the success of the project, or something that represents the performance of our project, or the degree our goal are achieved. Basically, we're going to stick to the loss as an indicator. So actually, the right-hand side of the horizontal axis represents losses. So so this part of the axis, actually the loss, and that's the part we try to avoid, and that's the part that we are afraid of. And on the other side, we have profits, so something that we favored, all right? But sometimes, in some cases, we may see reversed axis and right-hand side. So the positive part of the axis will represent profits, and negative side will represent losses. But in most cases, we're going to see this picture, all right? All right, so this is the risk. But that's what we would like to see at the end of the modeling. But the process of the modeling is kind of different. First of all, we need to understand what determines the P&L distribution, what drives the distribution of the result of our project, of our business, of our portfolio, everything that we try to analyze regarding the risk. And the first step that we have to take in order to model this distribution and come up with this distribution, that we first need to identify risk factors, because that's what drives the risk of the project. That is the complex system, and this is the package actually of the risk factors. So risk factors, they are the variables that represent uncontrollable and unpredictable processes underpinning the entire business or project. So they can be represented by returns on stocks, interest rates, some characteristics of borrowers, maybe some credit spreads, inflation rates. Any basic economic variable can represent risk factor, because generally we don't have full control of them, and they are predictable only to some degree. So they're always a residual risk that we may face dealing with them. All those variables define potential scenarios or world states in the future. So this is actually the instances that we go into model. And those factors are going to represent basic distributions that then will be transformed into the single distribution of the result of the project or any other business. All right, and they represent some random variable, and those variable actually may be dependent. So they have some degree of interconnectedness, and some of the risk factors value of some risk factors may determine the value of another ones. Okay, so this is the basic factors. Another side of the risk that we have to model, or in some cases we go in to have it as a given, is exposure. So what is exposure? Actually, exposure, it is risk takers' actions that that make risk taker exposed or influenced by those risk factors. Okay, so for example, I'll give you an example. For example, I invest on a financial market. For example, I buy some futures or some stocks or some ETF. Actually, my actions are to select the financial instrument that I'd like to buy, and determine the quantity of the trade, right? But the risk factor that will affect the result of this investment is something that is connected to the issuer in the stock itself. So probably risk factors are going to be returns on a single stock, for example. But the exposure, the degree I am exposed to these factors, the degree I'm affected by those risk factors are the ETF that I buy, for example, and the quantity I buy, all right? Or I may buy some derivative instrument to get exposed to those factors as well. So I actually can choose the source of this risk that transforms the effect of the risk factor on my personal result. And I can use the direction and the intensity or sensitivity with the quantity or sum of money that I invest in those instruments. Okay, so actually this is my actions, and they may be determined. So for example, I have a decision. I made a decision. I'm going to buy, I don't know, 100 lots of stocks of Apple, for example. And that's it. No matter what happens, that's what I'm going to buy. But sometimes those actions can be random. So, for example, they may be driven by the course of the stocks, for example. And if, for example, price go up, I'm going to hold. And if it goes down, for example, I sell or buy another stock or something like that. But they should be actually determined in terms that I should definitely understand what I'm going to do in different scenarios. Okay, so in this case, they are random, but at each point of time, I actually pretty certain of what to do if I observe my risk factors. Okay. In this, exposures actually can be represented as a deterministic real value function of risks, and that's what we're going to do. We're going to represent some pricing formulas. For example, we're going to deal with bonds, and they are going to be functions of interest rates, and interest rates are going to represent risk factors. Okay. Another exposure representation is going to be trading strategy. So for example, how much I'm going to invest. So exposure is a set of risk takers' actions which are response to risk. I would say it's action which are response to risk realization, not to the risk itself, because so for example, as I said, if prices go down, so actually I realize losses, that's in this case I'm going to sell some stocks, or I'm going to buy if they go up. All right. So the final ingredient of any risk distribution is a horizon. Actually, we expose ourselves to the risk for the certain amount of time. So, for example, you can hold your portfolio just for one day. You can hold your portfolio for a week. You can hold your portfolio for a month. You can hold your portfolio for half of the year. And given different horizons, actually risk can express itself very differently. And it's not just because it accumulates over time. Even dependency between risk factors can change over time. So for example, if I hold my portfolio just for one day, I may consider all the risk factors as independent variables and deal with them as independent random variables. But for example, if I hold my portfolio for a month, some of the risk factors may co-work together, so they may be correlated on a long time scale. And in this case, the entire structure of the risk factors and the model can change. And in a lot of cases, actually, we are interested of considering different horizons. So we're actually concerned about how our risk can evolve over time. So for example, to set some capital requirements for our portfolio, just to make sure that we not going to lose everything on a one-day horizon, on a one-week horizon, on a week horizon, etc. Okay? And this is just a scalar. This is just a given determined number, but we have to come up with this. We have to fix it in order to be able to build our model. So this is the three key ingredients: risk factors, exposure, and horizon. Horizon we usually treat as a given. Exposure can be modeled or be considered as a given dependent on the complexity of our project or our portfolio or instruments that we invest in. And risk factors are always modeled. So they are random variables that combining together will give us our final distribution of P&L. Okay? Great. So here is a schematic process of risk modeling in case of market risk. So you can see some risk factors. So you can see equities, volatilities, interest rates, and we take the exposure of this to these risk factors through different individual positions in different instruments. So for example, we can get equity option, bond, any other instrument. So the modeling process contains building the model for each of those risk factors. We usually apply some data. So we can see historical data, the box of historical data right here. We also accompany it with some assumptions and expert judgments. It's okay. So at least we have to assume some particular distribution for form or family. We also may assume some dependency structure or something like that. We also may apply some approximations and simplifications just in order to be able to make this problem tractable. And after that, we attribute all those risk factors to the value of the uh, individual positions, to each equity, to each bond, to each option. And after that, we can generate scenarios on the entire portfolio, how the value of the entire portfolio may change over time. So for example, over 1 day horizon or for 1 week. Usually for a market risk, we have short horizons, like 1 week. So actually, we build the model for 1 day, but then we extend it to the 1 week because, for example, Basil Ackards required to quantify risk on a 1 week horizon. Okay, so this is the process. And by the end of the course, we go through all of those steps and see how can we actually get this distribution. Okay. So that's what the model looks like. So the final target is to obtain the distribution of the profits and losses, something that aggregates the entire performance of the project. So now we know what the model is. So we're going to build the model for individual risk factors. So we're going to identify those risk factors to build a model for them. So we're going to build a model for their dependencies. Then we go into determine the way we are exposed to these factors. So for example, we go into develop the pricing model of the instruments. We go into come up with a trading strategy or investment strategy. And then we go into evaluate all those risks on different horizons and see how the risk evolve over time. So we go into obtain distributions for representing risks on different horizons. All right. But as you remember, the title of the course has the assessment word in the title. So what is the assessment? Why we actually need this word? So what's the purpose? Okay, we can obtain the distribution. Probably that's what represents the risk. What else we need? The point is that distribution itself is not enough to make economic decisions. So any risk-sensitive decision or something or some risk-intensive activity actually needs one quantity, only one number representing the entire risk, because in this quantity, this number should be meaningful and it should be and we should interpret it in terms of some economic parameters or decisions. So for example, in risk management, we can be interested to determine the capital allocation. So how much money should I reserve to be sure that no matter what happens with my project or with my business on a certain horizon, I'm going to still alive and I'm going to be and I'll be able to continue my business and take another risk, take another chance to make money no matter what happens. So for example, I fail on my project, I'm still going to be able to to continue my business. Another point, I may be interested in limiting my own risks. So for example, I understand the distribution of the profits and losses in my business. And for example, I would like to avoid some outcomes, probably the most extreme that I cannot tolerate. And I definitely need to understand how much I will be ready to pay to someone who's going to cover those extreme losses for me if I'm not able to cover them myself. Another part, I'm going to, for example, lend some money to my friend or another business, or, for example, I'm a bank and I'm going to finance your mortgage. I'm definitely concerned about how much money you go in to invest yourself. So, what's the proportion of the credit in your own investment in a real estate? So, what's the margining? All right, just to make sure that no matter what happens with the price of the real estate, uh, my counterpart will be capable to pay off his or her debt. All right. So all these problems actually require the single number that represents money. So, for example, how much I'm ready to pay, how much money I so what contribution I may require of my borrower to invest himself, or what part of the distribution I would like to avoid. All right, and that means that I need to convert the entire distribution just in one single number. And that means that I need to come up with some statistic, which is the real valued single value function of the entire distribution. So you're aware of a lot of statistics like mean, standard deviation, quantile, maybe some more sophisticated statistics. So any function that can represent single value function that can represent the risk, the entire distribution, can be considered as the risk measure that correspond to the assessment purpose. So for example, if I would like to margining, this is the purpose. If I would like to determine the price of insurance, that's the purpose. If I would like to set some limits, that's the purpose. All right, so we have to come up with some measure that suits our purposes the best. All right, so let's consider what is the good or the proper risk measure. So let's consider some risk measure, just some function r, real valued function r of x, and x is going to be a random variable that represents profit and losses. So that represents the cumulative and aggregated risk on a project. All right, and let's consider some properties that makes the let's consider some properties that make particular measure the meaningful and practical. In literature, you may find the definition of coherent risk measure, which represents the meaningful and practical measure. So here we have 5 properties, and we're going to go through them one by one. First 3 of them are pretty technical and pretty natural, and we're not going to talk about them very much. But the last 2 are very important, and they are actually the means and tools of the modeling. Okay, but let's start with the first one. So the first one states that risk measure of 0 equals 0. That means no risk, no capital needed. All right, so if I don't risk, the risk measure is 0. So this is something that means I don't need anything. I don't need to set any limits. I don't need capital. I don't need to pay someone for insurance if I don't have risk. All right, that's what the first property says. The second property says that if you have some risk X, so for example, you invest your money in some market portfolio, or probably you lend money to someone else, or you invest in some project. But if you keep some money aside as a capital, or you make absolutely safe investment that bears no risk and certainly will pays off. That means that together those portfolios and those business have lower risk. So for example, that means, let's get to the first example back. So for example, I invest my money in a market portfolio, and I also provide some cash with it. So for example, I have some money in cash and some money under the risk in the portfolio. And the amount of cash is A. That means that adding this cash to the risk, I actually reduce the risk measure by the same value. Okay. Another case, I can invest in project and allocate some capital with this project. So the entire risk measure will be reduced by this value, and this will mean that I don't need, at least I will need less money to cover the risk than if I invest everything into the risky project. Okay. Okay, the third one. This is a tricky one, actually. Nick Popov asks, so a risk-free investment? Yeah, you can call it risk-free investment. So the proportionality principle. This is the tricky one, because on the one hand, this property means that risk measure is invariant of measurement units. So for example, if X is a risk and I measure the performance in dollars or in $1,000 or in cents, the resulting risk measure should be just adjusted proportionally to the relation between the units. Okay? I think it's pretty clear. So it doesn't matter in which units I can quantify my risk. But if I consider K in this expression as an exposure part, so for example, this is the volume of portfolio that I form. This property may not hold, because, for example, I think you will agree with me that risks on a single stock probably are different than risks on a huge portfolio representing the daily volume of the market. Because if you imagine that I would like to liquidate this position, and if I have only one stock, I can do it easily without price impact. But if I'm going to liquidate such huge position that comparable with the daily market volume, probably I cannot do that without transactional costs and without price impact. And this price impact will push the price against my my goals and my. So it's going to push price in unfavorable direction. So probably it's going to increase my risks, at least in magnitude. Do you agree? So this is a tricky one. So we have to keep it in mind all the time. So if we If we apply this property, we actually always assume that we operate in some range of liquidity. All right. So, for example, like we always should assume that we can liquidate, for example, our position without transactional costs. So this property has some limitations. Okay. Good. Now, very important property. Very important property. It's called monotonicity, and it represents Pareto dominance principle. It actually says that if you have two risks, for example, two projects, two risky projects, and no matter what happens, whatever the outcome that we face in a short while, almost surely alternative X, so the project X beats project X in terms of the performance. So X performs always, almost always better than X. Okay? So for example, I know this stock that always performs better than another one. Or I have option and I have future, and I know that payoff on option always, at least option pays as much as future, but in some cases it pays nothing when future actually requires payment from my side. So that means that that options beats futures in these terms. So if we're in this position and one of the project beats another one in terms of the risk, it means that in terms of the risk measure, one of the options is preferable to another one. Okay, so that means that I would prefer the risk that brings me less losses than another one, or brings me more profit than another one, no matter what happens. Why this property is very important? It's important not because we're going to compare two real alternatives in terms of risks. This property actually means everything in terms of approximation. For example, we try to evaluate real life risk, and it's very, very complicated. It has a lot of risk factors. They have some exotic forms. They have very complicated structure. They are dependent and so on. And exposure, for example, very tricky. That means that I can assume another risk. I can approximate the structure of my real risk with another one, which is almost surely not better than the risk I'm trying to evaluate. So it approximates it from below. So it's kind of more extreme risk that I try to evaluate. But for some reasons, for methodological reasons, it may be it may be simpler. It may be easier to understand and model it in these assumptions. And this principle and this property will allow me to approximate the real life risks with a simpler model, with a tractable model that actually can be very useful in a real life, in a real practice. Okay, so this is kind of art of approximation. That's why we actually need this property, and we would like to measure our risk with a measure that has this property. All right. And now, finally, fifth property. That's what called subadditivity, and it represents diversification and decentralization of risk taking. So that means that two separate risks, so actually their risk measures together should give you the value which is greater or at least equal as the real risk measure of combined risk. So for example, I'll give you an example. Assume that you are an exchange and you try to set some margin requirements for your participants, for the traders that trade on that platform. And if you consider, for example, two traders separately, and you evaluate risks on their portfolios, and you will assign margining or guarantee requirements according those assessments, according to those measures, together you will go into require more than actual portfolio will be formed on the platform. So actually you understand that the combined portfolio bears less risk than the risk you can assess from two separate portfolios. Another example, for example, you are manager of trading division in a bank, and you have two subordinate traders. You as a manager, as a supervisor, you have your own risk limit. So for example, you understand that you can take no more risk than 1 million. But you never trade. Your traders do it for you. And you should delegate this risk limit to your traders, to those who you supervise. And you understand that they will trade actually independently from one another. So you have to assess their portfolios independently. And then you have to assign your own limits to them, but you have to make sure that their combined limit should not be greater than your own limit. So you have to prevent constructing two portfolios that together will bring you more risk than your own limit. So you have to prevent constructing portfolios of two independent parts that you cannot cover with your own responsibility. All right. So if you assess those risks with coherent risk measure, which has this subadditivity property, you always can make sure that setting limits to your own to your traders will correspond to your own risk limit, because your risk limit is that what you see on the left hand side of this inequality. This is R of x plus y. All right. But two limits of the traders combined, that's what you see on the right hand side. Okay. Good. So now let's consider some basic risk measures. Some of them you're already aware of, so you definitely know what is expected loss. So this is just an expectation of the distribution of losses. Very easy. And actually, we go into check it on the next lecture. Either this measure is coherent or not. Another one is the maximum loss, but this is a tricky one because in fact you can take on risks that are not limited. So for example, if you construct some very exotic position of derivatives. Probably you may come up with a portfolio without any limit on risk. So technically, you may suffer any loss up to infinity. Okay, standard deviation or volatility, very easy, very easy to understand measure. It represents risk pretty well in terms of the range of or spreadness, all right? But to some extent, uh, it's quite impractical because it's very hard to find the economic parameter that you can attribute to the standard deviation itself. Uh, uh, so, for example, if we talk about expected loss, that's fine because we can actually assign something like insurance price to this. We deviation, probably we can compare a couple of risks in terms of what to do. Check. Do you hear me? I can see the sign that we have some problem with the connection. Okay, good. Another nice measure is expectile. I think you should remember this title, this risk measure, but I don't think that we go into get into very much detail about this because actually this is pretty nice measure in terms of its coherence. Yeah, Anton, yeah, I'll show it tomorrow. I will demonstrate it with a Python. It's much easier to show you when it's calculated than just express it in words. The only thing that I would like to tell you about this measure right now, that it is very nice in terms of coherence. That's the measure that academics will call probably ideal and pure coherent measure. But the problem is it's very hard to apply in a real life. So actually any practitioner, any company would try to avoid it if, for example, it will be mandatory according to the regulation, because it's very hard to apply. It's not only hard to apply, it's very hard to validate. So when we're going to talk about validation, I will explain what's the problem with the validation. So you can actually you can construct the distribution. You can, for example, measure the risk with this measure, but how you going to make sure that it is actually meaningful? How are you going to make sure that it actually works? The validation process actually deals with this problem, and in fact, the way we can check the validity and adequacy of the risk measure means everything in this course. So no matter how theoretically measure is great, you always have to take into account applicability and validation perspectives, okay? All right, but now let me tell you about most widely used and generally accepted measures. First of them is value at risk. I think that most of you have heard of this measure a lot. I don't know if you deal with this. Just to not waste a lot of time, I can tell you that this is actually the representation of the quantile concept of the distribution. And this measure represents the level of losses that won't be exceeded with a certain degree of confidence. So this is kind of the most extreme losses that you may suffer on the project, taking into the account the confidence level. All right. So this is a kind of quantile measure. So at these pictures, you can see how it arises from probability density picture. On the left-hand side, you can see the typical picture of credit risk. So this is the distribution of credit losses, and usually it represents, so here we actually deal with the right tail of the distribution. So this is the value at risk right here, dividing the blank area of this bell and the shaded one, okay? And this level represents the most extreme losses that we actually can see on our credit portfolio. Another picture for a portfolio on a market portfolio, we actually deal with returns on portfolio, and losses are represented in the negative values. So this distribution usually quite symmetric. It's not normal because usually the distribution of portfolio losses has heavy tails compared to normal distribution. But the point is, we actually searching for the most extreme losses on the left tail rather than right, because negative returns represent losses, okay? But here we deal with continuous distributions, something that represents risks that are pretty close to the continuous distributions. But at the same time, we're going to deal with discrete distributions as well. And there, regarding discrete distributions, we need slightly change the definition of the quantile. And here you can see the formulas how to deal with value at risk when you deal with discrete distributions. We're going to deal with this definition, and we're going to see how it's applied in real cases tomorrow when we go into see some codes and run some calculations on discrete distributions. All right, so please be aware of these definitions. I will reproduce them tomorrow in Collab notebooks, but please make sure that at least you understand everything that is written in these formulas, okay? Another prominent risk measure is expected shortfall. And this measure is very closely connected to the VAR. Actually, it is secondary to the VAR. So if we look at this picture right here, this distribution, distribution of the losses, it contains value at risk as a quantile here, this solid line, all right? And we understand that this level can be exceeded only with a 5% of the probability, okay? But what is expected shortfall? Expected shortfall actually measures the expected value of losses that exceed value at risk. So this is the expectations of losses over value at risk, okay? So for example, if you deal with the VAR as let's say as a capital setting value, okay? So for example, you set your capital in the bank on the value at risk level. So for example, you set your capital the way that this capital should be enough to cover any losses occurring within 95% of the probability, okay? But you're also interested in the expected losses in those cases when capital is not enough to cover the losses. So that probably will be the expected costs that will be transferred to someone else. So for example, that's the cost, for example, central bank is going to cover, or some deposit insurance agency will cover. All right, so this is the kind of measure that represents expected extreme losses. Okay. All right, I think that's enough for today. At least our time is up. I would recommend you to recall this 4 points for the upcoming lecture tomorrow. All right, and before tomorrow's lecture, please check the LMS. I'm going to post Colab template there, so you can download it, or you can copy it in your own Google Drive and follow me during the lecture. So do you have any questions? Yeah, Ekaterina, will you send us this lecture? Yes, sure. I'm going to upload this in LMS, and I think I will double the link on my own web page. Okay, so you can go to my web page on a portal, in an HEC portal, in a section teaching, and I'm going to leave there the link. Okay, but I think you will find the link in LMS, and that's enough. Okay. Any other questions? Yeah, I think so. The question about lecture, lectures. No, about literature. Yeah, we have some recommended books. I think you can find them in a syllabus of the course, and I will also provide you with recommended chapters. I think from tomorrow's lecture. So I'm going to accompany any material with recommended chapters from the book. Online courses, it's kind of tricky right now because probably we cannot recommend courses from Coursera, but Russian platforms do not have any course, close to mine in any degree. So I think I cannot recommend you any online course. Sorry about that. Maybe when I find time and record my own, but that's the matter of future. All right. Okay, so this is it. I see you tomorrow. Have a good night, and bye-bye. Ciao.